Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome back, Art Jarvis. Taking Stock.
How we doing?
Good. Episode number 18 is underway, my friend.
We are rocking and rolling.
We are, and you know what? Rocking and rolling. We're going to get right into it because the last two episodes we were working our way through your forecast. Well, the last episode we were working our way through your forecast, and we didn't quite get done. Mm-hmm. We're going to leave one of those forecast items out because it has nothing to do with the finance or economy or investments or anything like that. Sure. But we do know this is it is Super Bowl week as we dive into episode 18 on this Tuesday, February the 6th, yes. As we record this. But so 49ers and the Kansas City Chiefs, and we don't really care, do we?
The majority of the country doesn't care, I think, based on what I'm hearing.
But anyway, it's Super Bowl week. It's episode 18 of Taking Stock, and picking up on the things that we really care about with Taking Stock is the forecast for the economic things. He's going to make me put my glasses on. He's showing me what he has here. We're going to pick up with discontent in Washington or the Republicans.
The election and things like that, yeah.
Right.
Yeah, I got to hit that part too. So yeah,
we're going to touch on all those.
Sorry to interrupt.
Hey, it's your show, Art.
Oh, is it?
Absolutely. Oh. This is Taking Stock with Art Jarvis. Mm-hmm. Chuck Gibson is just here to make sure we don't take too long. Yeah, I think.
If Chuck Gibson's not here, we don't have a show. Let's be clear about that.
Well, I'm Chuck Gibson, and that was Art Jarvis. And thankfully, hopefully you folks are going to get something from us here in the next 20 seconds or so. We'll get moving.
Yeah, right. We actually talk about something. So. Yeah. Exactly. Yeah, so last week we kind of hit all the economic, and we talked about the S&P 500, we talked about inflation, we talked about employment, we talked about real estate, we talked about all those kinds of things, and where we thought that was going to lead. So I painted what I think is a pretty positive picture for 2024.
I agree.
I did have, the title of it was Bumpy, 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 and I still believe that's going to be true, that, there's going to be several things going on this year, and some things from a psychological standpoint, which are already showing up here in January and February. So, but yeah, we did that, but then, I did have a couple other things. One is, we have an election coming up this year, which is going to add to that volatility. And then I also always kind of throw two or three kind of what I call wild card predictions that, don't necessarily have anything to do with 2024, but might take a little longer term perspective on things.
And those are the things where, when we left off on Art Jarvis' financial forecast, economic forecast, investment forecast for 2024, we stopped right before all your wild card.
Yes.
So the people who are listening are on the edge of their seat anticipating the wild card, because that's the fun stuff.
Right.
We hope.
Yeah, it should be fun.
Oh, good.
I'm not betting the ranch on any of these, but one of a couple.
Well, we are holding your feet to the fire because this is recorded, and we're going to be able to call you out on this as time passes.
Well, I most certainly can live with that. But we talked to continue with kind of talking about economics and the economy and things like that. We're in 2020 we were at roughly $21 trillion on the national debt.
Ouch.
So 2-3 years later, we're knocking on the door of we're at $34 trillion in national debt. So I just kind of went forward, but my one thing I said is we could very easily be at $36 trillion by the end of this year. So with everything that's going on with the budget, our cost of debt is going up. We've talked about that in past episodes. So we could very easily be at $36 trillion just in the next 10, 11 months. So, which is not a great thing, in my opinion. We've talked about this before. We can't run our households this way to local Loveland, Ohio can't run their budget that way. Ohio can't do it, but apparently, the federal government can just crank out money as fast as they want. And, somewhere along the line, and I'm not smart enough to tell you whether it's 5 years or 50 years, somewhere along the line, that's going to be a problem.
Well, you know what, Art, that's the question as I'm listening to you talk about the potential of a $36 trillion national debt.
12 zeros?
Shh, don't say that out loud.
Okay.
Yeah, I hadn't even thought about that, but you get, the million, the billion, and then the trillion. So, yeah, that's 12 zeros.
Yeah.
The point is this, the question is this. What are the implications of a $36 trillion national debt in terms of the impact on the U.S. economy? Reality.
Yeah. Well, I mean, number one, the most obvious thing is what I mentioned before, is our cost of our national debt is rising. It was great when we only had, point something percent interest rates up to maybe a couple percent or 3% interest rates, but now we've gone from 0.5 up to 5%. If you look at the 10-year Treasury, it's slightly above 4% right now. So when it comes time for the current Treasuries to mature, we're still running in a budget deficit, so that money has to be rolled over and they have to refund those bonds. Well, now instead of doing it at 0.5%, now they're doing it at whatever the average percent is along the yield curve. So our cost of debts, which then also accelerates our national debt, right? So it's a vicious cycle when you're sitting here. So somewhere along the line, our leaders have to figure out a way to run this country in the black. But yeah, it's what happens when our national debt becomes bigger than our U.S. economy? If
that's the question.
Yeah. So if the U.S. economy is making whatever it is making, $10 trillion a year, and our debt is $2 trillion per year, But what happens when that $2 trillion starts moving closer? The 10's going up, but the 2's going up faster, and it keeps closing. So our national debt as a percentage of our gross domestic product keeps getting higher and higher. Now you can't run your life where you make $100, but you got to pay $100, or you got to pay $120 to pay all your bills and things like that. So that's the direction we're heading in.
How do you improve the GDP?
Well, the consumer is 70% of GDP, so but you can only rely on the consumer for so long, and that's kind of the concern right now. Is the consumer has been very strong for the last couple of years, but they're also spending a lot of money that was pumped into the economy over the last couple of years. So now,
which increased the national debt.
Which increased the national, that was part of that $6 or $7 trillion that was pumped into the market, after COVID. But yeah, it's that have they already spent all that money that they were given, and now they're starting to go into debt. They're starting to spend on their credit cards and things like that. Right. So now you start to generate another problem. Then you start having defaults and things like that on credit card debt, and that starts to impact the banking system and things like that. So, it's so number one, the consumer, and then number two, if you really want to fix the problem or start to put a dent in the problem, you need to stop spending so much.
Well, and again, at the end of the day, the GDP is one thing, but the spending, and so our budgets, which every year we get to this point, we the people hear the news, they haven't approved a budget. Congress is going out on the holiday breaks, and they're going to have to approve a temporary budget to keep the federal government working. And it's just spending. It's just a spending budget. And so I guess at the end of the day, what we hear about, let's say from candidates during campaigns, is balanced budget.
Yeah.
Does it ever happen?
It has some in the past, but generally it doesn't last very long.
Right.
You know,
Well, how do you get what? It's like these are the things you can control. You can't control. We're going to make more money. You can control what you're spending. I mean,
Correct.
if you look at my budget at home, as you said, like City of Loveland, we can't create more revenue necessarily, but what we can do is find places to spend less.
Correct. It's interesting to me. People say to me, well, I'm on a fixed income. Well, technically, we're all on fixed income.
I call mine a broken income.
Broken income, right?
Yeah, no.
Exactly. I hear you. But technically, I'm on a fixed income also, right? There's,
Right.
If I want to go buy a toy or something, there's any magic money or there's not a money tree out in the backyard that I go shake and increase my income, right? So, but
Well, I was thinking about coming over by your house and shaking that tree, but it's not there.
good luck. You might get some black walnuts or something.
It's not there.
Yeah.
No money tree in my backyard either.
No, and my dad used to have a saying. It's like, go outside and get it off the money tree. And I understood what he was saying.
Here we are.
Yeah. God bless Dad.
Well, those who are listening they don't have that money tree in their backyard.
Nobody.
either.
Yeah, right. Well, but the Fed seems to have a money tree. Every time they want to spend more money, they just go downstairs and print more money, right? And
Sure.
that's a problem.
Well, and then that's the national debt.
That's the national debt, and that's the problem. So, it's always interesting. There's a debt ceiling, right?
Okay.
But every year we take the debt ceiling and just raise it.
Right.
Well, that's wonderful. That debt ceiling was put in there for a reason, and I do understand that debt ceiling can move up because of inflation and things like that, and that to strengthen the economy. But they just keep raising the debt ceiling because they have to.
Yeah.
It's not like because they looked at it and said, well, inflation is this and this. No, they're raising the debt ceiling because if they don't raise the debt ceiling, the government's going to shut down because they can't run the economy based on that debt ceiling. So, yeah, I mean, it's something that you can't just keep kicking the can down the road, or and the longer you wait, the uglier it'll be, in my opinion.
Yeah. Well, and the short answer to what's the implications of a $36 trillion national debt by the end of 2004, potentially.
2024, yeah.
I mean, I'm
Yeah,
sorry.
right.
Yeah, 2024,
Right.
As forecast by Art Jarvis here on Taking Stock. So the short answer is the implications are, this is just going to move us more speedily to that crash course where the GDP and the national debt meet, and then there's a problem.
Right. And it was just this past week, we passed some multi-billion-dollar package that's going to help Ukraine and going to help Israel and things like that. Well, there's another example. It's not only are we doing things to try and take care of things at home, but we're trying to take care of the world with this money too. But you already got a $2 trillion deficit, yearly deficit, and now you're adding to it. So,
Right.
Wrong direction, I guess, is the point. So
On that,
yeah, 34 trillion is not 34. I'm sorry, 36 trillion is not a bold prediction. To be honest, it's the you can go on the internet and there's actually a national debt clock, and
Right.
and that 20 years ago it was moving pretty good. Well, it's nuclear powered now. It's spinning, right, and it's amazing how fast all that adds up.
Yeah.
So.
and it lands on our doorstep ultimately. That's,
Somewhere.
Yeah, so-
I mean, I did the numbers a while back, and if I remember correctly, if we were to pay off the national debt, that would be $120,000 for every single American toddler through, retiree. That's
almost a foot in the grave kind of thing.
Yeah, so I mean, if you got if everybody had $120,000 laying around they didn't need, we could pay it off, but that's not how it works. So, the other thing was, and this is
Next up on the wild card forecast.
wild card forecast is the S&P, and I pushed this out a few years, but right now we are trying to get the 5,000 on the S&P 500. We keep kind of getting close and moving back, and
40. Where are we at right now?
we're 49.70 or something along those lines. Yeah, as of today. But we will be at 7,500 by 2030.
Okay.
So
That's not just a 2024, as you said. You're pushing that one out a few years.
And again, this is where I kind of start throwing things out there, something maybe to chew on.
Wild card, yeah.
But 7,500. You sit there. If we go from here and from now to 2030, if the S&P 500 goes up 7% per year, that puts you at 7,500. So it's not. Once again, I'll hold myself over the fire. It's not that bold of a prediction, right? If we make 7%, and honestly, I believe we'll probably make more than 7% per year.
I was going to say you're playing safe bet here.
Yeah, a little bit. Well, you never know what they're going to throw at you. So.
Well, and again, the same question comes from a forecast like that. If the S&P does in fact hit 7,500 or better by 2030. As forecast here on Taking Stock, episode number 18. The question's the same thing. What's the implications? What does that mean to me and my investments, or me really at 2030? What does that mean to me and my children and their children?
Right.
What would you say?
So, if the rule is 72s, which is you take the number 72 and divide it by the interest rate or divide it by the number of years or whatever, try to come up with the answer, the missing piece. So, let's just say between now and 2030, we're going to make 7% per year.
Okay.
That means at 7% per year, that means your portfolio is basically going to double in about 9 years. So, if you're sitting here with $100,000, by you go from here to there, now you're probably looking at $200,000. So, that's the beauty of, we've talked about this, the beauty of compounding, right?
Right.
As you get older, those
Albert Einstein.
Not Ben Franklin, or Mark Twain.
Thank you. Well, you know what? I trusted you on the Ben Franklin. I've been sharing the word, and then you corrected yourself and me. It's Albert Einstein is the one with the quote. What was his quote? We're going to look at it real quick here.
Interest rates is the eighth wonder of the world, or something along those lines.
Here it is. Right. Direct quote, Albert Einstein. Compound interest is the eighth wonder of the world. Yeah. He who understands it earns it. He who doesn't pays it.
There you go.
Accredited to Albert Einstein.
Yeah, I saw that. I sent it to you immediately.
You did. You did. And I appreciate that.
Mr. Einstein, he was a smart man.
We like to keep our listeners informed, but also informed accurately.
Yes,
and it's Albert Einstein gets credit for calling compounding the eighth wonder of the world.
Yes.
And so hopefully while you're listening, we're helping people understand how compounding works. And so if 7777 between now and 2030, 7% growth, 7% growth, 7% growth, 7% growth, 7% growth is not 35% increase, but ultimately with compounding 100%.
Much more.
Well, actually about 50 to 60% by the end of that fifth year.
And the thing to emphasize on that is we've talked about this numerous times also about sticking with the plan.
Amen.
Okay? So it's not 7% every year. Some years you're up 20%, some years you're down 20%.
But an average of 7 over those years.
Average annualized of 7%. So if you stick with the plan and try to outsmart yourself, you get out when you think things are going to be bad, and it was proven here in the last few months, October, November, December of last year, and even January of this year, we had a huge move up. And if you missed that move, you missed the vast majority of that 7% compounding.
Well, see, and my question as we're sitting here, I was going to ask you, so how much did I lose because I've been, I'll say, procrastinating over the last 4 months?
Okay.
With a certain sum of money that I wished to invest, and I thought I'll just do it an easy way, and I haven't done it. So, how much did I lose percentage growth?
Well, probably somewhere between, in the S&P 500, probably in that 26% range. Yeah, 26, maybe 27. Yeah, so
You're
it's a big,
killing me.
it's a big. Well, I know
25 cents on my dollar.
These are the
basically.
conversations we have. These are
Right.
the conversations we have on the phone. It's like, well, I want to get out. It's like, no, you don't. You know, I mean, there are good reasons to readjust at times. You know, the financial
Sure.
crisis in 2008 was a wonderful example of we need to adjust. Okay, wait for the ugliness to pass and then get back on task. You know, but if you're just and again, we talked about the negative rhetoric all the time. There's so much negativity out there, and it's causing people to panic. And my point is that the rhetoric doesn't match the numbers.
Yep.
But you're causing people to bail out, to panic. You know, again, it's that fear and greed thing. You know, so fear makes you do one thing, greed makes you do another thing. They are equally bad, and you know, you get pushed out, scared out, and then you miss a big up move,
Right.
and then you want to get back in. It's like, well, you missed the up move. You know, there was a study.
We might be on a downturn right when you climb back in.
Yeah, I mean,
And then you're going to be mad. What am I doing?
yeah, there's a curve, right?
Right.
There's troughs and there's peaks, and people will over and over again will get out very close to the trough, and will try to get back in real close to the peak. You know, so there's capitulation going on at the end, and that's kind of, you know, yeah. I mean, it's that capitulation. Like, I watch for that capitulation when you see them. You know, all of a sudden, just they're selling everything off, and it's big numbers and it's big volume. That's usually a pretty good sign that all the weak ones, if I can say it that way, have moved out. You know, and now the ones who are willing to hang, and then, you know, and we start moving back up again. And then those people who got out, you know, we're 60, 70, 80% our way back up the mountain again, and that's when they decide to get back in.
Late to the party.
Very late to the party. Yeah, fear, and then it becomes fear of missing out. Right. FOMO. Fear of missing. Now you're scared you're going to miss out. It's like, well, you not going to miss out. You already missed out.
You did.
Yeah.
It's an interesting. What do I want to call it? I lost the word, but I got all kinds of fancy words for it. But I mean, it's an interesting thing to look at and to view, because the truth is, like I just said, late to the party. Mm-hmm. Well, you may have been early to the party, but you left.
Right.
So it's left the party, came back late.
Right.
You know, you need to stay at the party for, you know, even through the part where they're playing the bad music and somebody ran out of drinks,
Right.
or whatever. Just hang in there, because the music's going to get better.
That's exactly right.
And somebody went to get the next keg.
Right. It'll be okay. He'll be back in a minute.
I'm sorry, it wasn't a keg. It was simply some fresh,
Right.
ice-cold lemonade.
Yeah.
But somebody went to get that refreshment and better music.
Right.
And it's going, you know, you got to stay at the party.
100%.
Yeah.
You got to stick with the plan unless there's something in. You know, people. The one thing is like, I hear it frequently that I don't want to lose all my money. You know,
Right.
the fear is like, I'm heading into retirement. I'm in retirement. I don't want to lose all my money. Well, something really bad has to happen in the world for you to lose all your money. Okay, now, you know, a 10% drop is actually pretty normal. So you lose 10%, just stick with the plan. You'll come back. You lose 20%. You know, things like that happen. You know, there's always something to worry about. So what do we end up focusing on? But, you know, if you're willing to put up with that kind of shorter term volatility, you end up being way better off in the long run.
Well, before we started today's episode 18, I said to you, you know, the question is our growth, our personal growth for investors, and even the U.S. economic growth, is it outpacing, for example, inflation? Mm-hmm. You know, that, because if I'm paying more and I'm paying more and I'm paying more, well, am I earning more? Mm-hmm. And are my earnings, are my revenues, are, you know, whatever, is my portfolio growing at a pace that's going to outdistance my expenses?
Right.
Or am I now looking at, you know, the success of my retirement plan, you know, the percentage of probable success for my retirement plan as it is now just went from, you're 95%. You're going to be right where you want to be. And now it's more like you're at 79%. or are we, in fact, in growth with our investments and with the U.S. economy? Are we outpacing the rising costs?
Right. Yeah, that's a great question. So it's an ebb and flow kind of thing.
Right.
I mean, so 2022 we had 9 or 10% inflation. Clearly, we were not keeping up with 9 or 10% inflation. Right? Our portfolios weren't keeping up. Our increases in pay weren't keeping up, and things like that. But then 2023, you take, for example, like United Auto Workers. Well, now they've got a 25% increase in pay over the next, whatever it was, 3 or 4 years. Right. So now they got the kicker. Right. Now, but at the same time, they got the kicker and moved them up, but now inflation's moved back down to 3%. So it's kind of an ebb and flow kind of thing. But, I mean, let's be clear, 9 or 10% inflation is damaging to most households. I mean, it puts a lot of pressure on the household. So if I had to, without putting the pencil to the paper, I would say that we're doing a pretty good job of staying with it. Okay. But I do all my work based on right around 3% inflation. I'll do a range, but let's just call it 3% inflation. That's what I call normal inflation. When I sit down and talk with a client about who wants to retire, what does my monthly income and my Social Security, and put all that together and compare it with expenses and things like that, I try and put together something and show them that, okay, if you take out this amount of money per year based on your assets and things like that, not only are you able to produce that monthly income, but your portfolio, you're not dipping into the principal, and you're keeping up with that 3% inflation. So if you got to go buy a gallon of milk today or 5 years from now, you're still able to buy that same gallon of milk. Okay, so and that's important.
Regardless of the fact that same gallon of milk went from $3.79 a gallon to $4.50 a gallon, whatever it would have been.
That's right. Yeah. We and don't forget. Let's say you retire at 65. You might live 30 years. Well, that gallon of milk is going to go up a lot in those next 30 years. So it's important to take into account when you're talking about retirement things that not only can I retire today and keep up with my monthly expenses, but I need to be able to keep up with my monthly expenses 20, 25, 30 years from now.
Well, and that's exactly where we're projecting the success of the plan that you're in, aiming for retirement and continued living after you retire. That's the question. Are we outpacing the rising costs, or at least, and the answer to the question, ultimately what you just shared, is you're going to say comfortably we're staying with it.
I think that's a good. I mean, obviously there's the group that's way ahead of, and then there's a group that's way behind, right? So, and that comes back down to,
and we don't mind being somewhere in the middle.
Middle is okay. Yeah.
We're staying with it.
That's right.
If I'm outpacing it, Chuck happy.
Yeah, right. Yeah. you pull up to the gas pump, you don't care you don't even know how much it costs. You're not worried about it. Yeah.
Fill it up.
There are people in this world that what that gallon of gas costs makes a huge difference in their monthly expenses, right?
Yeah.
So to be fair, it's kind of that ebb and flow, and I think that's where we're going on in our economy right now. Is there's an adjustment going on for we pumped a bunch of money into the economy. That jacked up inflation, and interest rates have gone up now. And now the employers and employees are working to try and play catch up to where they fell behind, if that's the way of putting it.
So where do we want to go? If we continue on the wild card forecast, what's next on it? And we got a couple of minutes to wrap up here for episode number 18. What do you want to tell us?
Then the real wild card, the one where I just kind of make some kind of wild prediction or whatever, is Vladimir Putin will not be in the Kremlin by the end of the year.
Wow.
So I just and this is not based on any great research or anything, but I think he has overstayed his welcome, for starters, and I think that's true for a lot of his countrymen, and they feel that way also. So he operates in a world that necessarily in the world that he believes that really doesn't exist anymore. And I think a lot of people are starting to see the writing on the wall, and I think there will be an adjustment in some way, shape, or form. And I wouldn't be surprised. And I'm not talking about someone's going to go in. I think that'll come from inside the Kremlin. To be honest with you.
Oh, right.
So,
Yeah. That and that excuse me. That would have been the question that I posed to you afterwards. Is that how is that going to happen? What kind of forces are going to cause that? Well, they're going to come from within.
Yeah.
But the pressure on those within that will make that happen, if your forecast is correct, if the prediction is true, I tend to support the notion that Putin will be out. Maybe not by December 31st, but soon thereafter, if not.
I think it's in process.
November 5th may have a lot to say about that as well here in the U.S. Right. But it is. So your answer is it'll come from within, which that's a good thing because that doesn't mean it has to be some kind of a big war thing.
No, it needs to come from within.
Right.
Yeah.
That's the right way to say it. Probably.
Right.
But
so that's the big bold kind of pull it out of the blue kind of prediction. So much more. Well, I mean, actually, that does have some importance on the global economy, but more importantly is all those other things. We're talking about earnings and interest rates and real estate and inflation and employment. Those are the important things that we really need to focus on. And if I have time, make one more comment real quick. The interesting thing already is we talked about that, I'm looking for maybe a couple rate decreases in the second half of this year. Well, the Fed just met in January, and, everyone was looking for them to cut rates by a quarter point. Not that was the discussion. And they're too far ahead. The pendulum has swung to the other side. Now we're not worried about them raising rates. Now we're expecting rate decreases. Well, they were looking for the economy to grow in the fourth quarter last year by 2.2%. It grew by 3.3%. It's way ahead of what they're talking about. The whole point of lowering interest rates is you're actually kind of tapping on the gas pedal, the accelerator, to make things. We don't need to go faster. We're at a good clip right now. And the one thing I actually like, I'll give him some credit. Not only did he say, we're not going to lower rates in January, but we're probably not going to do it in March either. Well, that goes back to I'd be surprised if they lower rates in the first half of this year. And I think we need to come back a little bit to reality. Maybe we get a couple of rate decreases this year. It's not going to be 6 or 7 rate decreases unless something just completely changes substantially.
Well, when next we meet, it'll be the 20th of February, when the next time you and I meet to record the next edition of Taking Stock, we'll be taking stock. I mean, we're going to be 20th of February. You're moving into 2024. Things are happening. And on episode number 19, we'll be talking to the people about the way things are looking. I mean, we're touching on it a little bit now and in most recent episodes. But get back focused on what actually is happening and what's gone on in the 14 days since today, by the time we get together 14 days from now.
Yeah, and I look forward to it. I mean, the last couple episodes has been a fun and productive exercise for me. And hopefully other people got something out of it too. So, but we'll get back to current events next time. Taking stock on current events. So, Art Jarvis, thank you so much. Thank you, Chuck. Appreciate it, as always. It's a pleasure to have you and a pleasure to be with you. Thank you. We'll see you next time. Next time on Taking Stock number 19. All right. Thank you. You bet. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.